Today's session, we're going to be talking about social accounting and international trade. It should span over 2 sessions, so we'd cover some of the basics today on social accounting and introduce international trade, and then we'll move over into the remainder international trade in our next session. So to begin with, what we want to start to discuss, or we will begin discussing the term standard of living, right? Describe something. Does anybody know what the standard of living is? So I'll tell you, basically, when we talk about the standard of living, or you hear the term standard of living, what we're talking about there is the wealth that is experienced by a country. And the different ways in which it is, we could look at that wealth that we're talking about. One of the ways of looking at it is based on the average disposable income of the population, right? Also, the ownership of capital equipment. How much of the capital equipment used in the production of goods and services locally is owned by the country itself, by the locals of the country. The level of research and access to modern technology, and also the quality and the quantity of goods and services enjoyed by the citizen. So when we talk about the a country's standard of living, there are some factors that we will look at to determine the standard of living of that country, right? Some of these factors include things like the level of goods and services available. So we're talking about the goods and services that is required to satisfy the needs and wants of society, right? So that could be in terms of goods, we're talking tangible products. That might be things like cars, access to computers, cell phones, right? Medication, right? Even in terms of broader goods like food stuff and items like that. Services, right? So we have many different services. Education, you can think of as a service, healthcare as a service, transportation as a service, Wi-Fi and telecommunication as a service. You could also look at another factor, which is the average disposable income. Usually when we're talking about this, we see this better example of this later on in our lecture. We talk about the per capita gross domestic product, or the per capita gross national product. When we say per capita, we're looking at the total amount of production, right? Divided by the total population. We'll get into that later. And what this tells us is the amount of, or the average amount of earnings each person in an economy would have. Ownership of capital equipment. We're talking about capital goods and investment goods that are used to create consumer goods and services locally or for export. So we're talking in terms of, the manufacturing plants and factories. For us, in the past we had Petrotrin, and we would get our oil and gas and stuff from them, or National Petroleum, right? They're the ones that actually handle our fuel. Access to modern technology. So usually you find that countries that are described as having a high standard of living would have access to modern technology, and that helps them to remain competitive by producing at a very high level, right? When I say modern technology, we're talking about not just like cell phones and computers, but automation, right? In their manufacturing industry, they have access to, computer-aided manufacturing through robotics and things that automate processes, so they could produce more. Some countries, when we talk about access to modern technology, even in terms of their food supply and the way in which they do agriculture, do they have, there's this container farms where they could set up food production in controlled environments. And even if they're not doing that and they're doing, I was looking at a video recently, and there are these huge greenhouses that they have in some of these European countries for producing vegetables, where they actually use like solar panels to trap sunlight, and then they have natural irrigation. Well, not natural irrigation, but they use rainwater that they trap, or dew that they trap from on the roofs of the farms, and then they recycle that into the actual water system that they're using there. They recycle the water. I was looking at a video recently with Moda Life, their store location in Valsane. You know, it's you should probably check it out. I'll probably share the video with you guys in the WhatsApp chat. They use a lot of renewable energy there. They actually collect all of the rainwater that you know, they get from when rain falls and run off the roofs, and they have an underground storage tank where they store their own rainwater, and that's what they use as their water supply there, right? So that's the type of technology that we're talking about: telecommunication, transportation. You know, when you look at China, they have a very efficient transport system through their rapid rails. That type of technology allows the movement of goods and even persons as well too, right? The human capital, the human labor at a much faster rate. All of these things here is going to help improve the standard of living, because again, when we talk about standard of living, you know, you already talk about more tangible stuff. You know, it looks at the level of production, and having access to modern technology is going to assist in increasing that level of production. And if the level of production increases, then the level of wealth that is experienced by the country should increase as well. Yeah. So measurements of standard of living, very often you come across questions that ask about, you know, how is standard of living measured? Well, I mentioned previously on the other slide, the gross domestic product. And that's just a big word that means, you know, the amount of output that happens within the country. The word domestic there means local or at home or home. So when we talk about gross domestic product, we're looking at the output within the country, but both goods and services that is produced in the country. The gross national product, on the other hand, is the sum of the money value of all the goods and services that is produced by the economy, and is over a period of time. But it identifies output that is not only produced locally, but is nationally owned factors of production, both domestically and abroad. Because sometimes companies within our country may also be producing abroad. Like, for example, Carib Brewery, and you purchase brewery in, I believe it was in the States, or reading this some time ago. So they are producing beer, or, you know, whatever else they produce out there in another country, right? And what would happen in that case that after they pay their profits and pay their taxes, sorry, in that country, the profits made there is repatriated back to Trinidad. So that's, you know, foreign earnings that they make in another country. So when we talk about nationally owned factors of production, both locally and abroad, or domestically and abroad, that's what we're talking about, right? Nestle, for example, that's not a Trinidad-based company. That's actually a Swiss-based company, if I'm not mistaken. So when they are looking at their gross national product across there, you know, they will take into consideration the factors of production that they have abroad. Yeah, that makes sense to everybody? Drop a Y in chat, but if it does. Yeah. Million, not, you understand that as well? Right. So going on with some other measurements of standard of living, there's also the per capita income. The per capita income talks about the national income, so the total national income, both home and abroad, what we just described before, gross national product. And we divide that by total population of the country. And that gives you the average income for each person in that country. Other measurements of standard of living includes the physical quality of life index. This measures things like the infant mortality rate, pollution, literacy level, and life expectancy rates, right? And there's a human development index. This is a measure of your per capita income, things like inflation, as well as illiteracy rates. All of these are different measurements or metrics for the standard of living. Right, so to summarize, the standard of living looks at those factors that indicates the country's wealth, right? And when we say the wealth, we're talking about the quantity of goods and services that is consumed. It also includes the quality of food and the type of housing available. And the factors that determines the country's standard of living include things like the level of consumption of goods and services, the average disposable income of the population, the level of national ownership of capital equipment, access to modern technology, and the level of investment in research and technology. So I have a short video for us to look at. So now what we want to discuss is something else called the quality of life, right? Because there's the standard of living and there's the quality of life. They sometimes are a bit difficult to distinguish between, but they're two different things. Now, where the standard of living is somewhat tangible in nature, meaning that they're physical things that we could look at. When we talk about the quality of life, we're actually looking at more intangible things. What I mean is that things that we can't actually, like physically hold or look at those things. It's more about the extent to which the population enjoys the benefits of its wealth. So indicators of a country's quality of life would include things like the extent of security involved in the country, meaning the level of crime, how well does the country handle its crime situation, the availability of health, educational, recreational facilities, right? Diet and nutrition, life expectancy, rate of infant mortality, and access to public utilities such as like electricity and potable water, like access, everybody being able to have good quality running water. Now there's a difference between these two. And as I was mentioned, whereas the standard of living is measured by physical quantities, the country's quality of life is determined by the quality of the goods and services enjoyed by the citizens. So that's kind of intangible, right? Quality you could rank as poor, fair, moderate, or good or excellent. So, like I mentioned before, safety, a low crime rate, right? Good diet and nutrition, access to good quality food, environmental quality is there, good air quality is there, a low level of pollution in terms of, like polluting on the rivers and the seas. Even the quality of health and educational facilities, right? That is available to the population. 1 second, guys. So the standard of living is mainly determined by a per capita income, but the quality of life is determined by more intangible subjective factors. All right, so let's look at another short video explainer. Right, so now we're going to take a look at national income. Now that we have examined and looked at the standard of living and the quality of life, and we understand the difference between the two. Do you guys understand a bit more the difference between the two, where one looks at a lot of physical quantities, tangible things? So example, the amount of luxury and wealth that is enjoyed by the population, whereas the quality of life is a lot more intangible. It looks at, human well-being, their state of mind. Are they satisfied? Are they peaceful? Right? Are they at ease mentally, psychologically? It's a lot more intangible stuff there. So you could have a high standard of living, but then a low quality of life. Follow us in? You guys understand that? Just drop a one in the chat, but if you do. Yeah? Okay, excellent. So now we want to talk a bit about national income, right? And under national income, when we talk about national income, what you're discussing or what we are referring to is the total income earned by a country, right? And this is from the production of goods as well as the provision of services. And we usually look at this for a particular time period. So it's usually done for a year. And it's after we deduct something called depreciation, which I'll get into a bit later. So it measures the level of economic activity in a country within a year. And when we talk about depreciation of assets, we take it into account when looking at capital equipment as they change in value as time goes by. So another definition is it could be the total value of money value, not just any value, the money value of goods and services that is produced by the country over the period of a year. Now, when discussing national income, we tend to look at something called the circular flow income. And the circular flow income really looks at how money moves around in the entire economy, from the households to firms and businesses, back sometimes to the households, because firms and businesses employ the same people that purchase the goods from them, right? And then we would look at the role of the government as well, because some of this money filters and goes to the government through taxes and stuff like that. All right, so I have another video explainer for us to look at, and then we'd look into the notes on the circular flow of income. Right, so this is how the circular flow of income works. Basically, from what we looked at, the businesses produce and the households consume, right? So the households are the ones that own the factors of production. They have the land, sometimes labor, well, not sometimes. They have land, labor, and capital enterprise. And they in turn exchange that with the firms, right? Sometimes they rent land out or they sell land out to businesses, right? And businesses in turn take this and use their labor in order to produce goods and services, right? Firms have to purchase these factors of production in order to produce. So wealth tends to flow from one form or from one to another, right? So the consumers, they spend money in purchasing the products from the firms, but then the firm also spends money like for wages by paying them an income, a salary, by paying rent for the use of land and space, and even for paying them for investing in their company. You know, sometimes you may purchase shares in a company and you become a shareholder. When the company makes a profit, they pay you a dividend as your profit, your share profit out of the total profit made by the company. So total income is equal to the expenditure and the output inside of the circular flow of income. This is one set of money that is really just being exchanged over and over and over. Important terms that we have to use in social accounting. So now that we understand the circular flow of income, and you need to know that diagram, right? We'll just talk about these two again, gross domestic product and gross national product. The gross domestic product is the total money value of all output produced within a country over a year, right? Domestic refers to income earned from local production only, whereas the gross national product looks at the total money value from all output produced over 1 year, both within a country and from its overseas investments. So the gross national product is the gross domestic product plus any overseas earnings by nationals. So I mentioned, you know, like Carberry having a brewery in another country, right? I saw Bertie's pepper sauce selling pepper sauce on Amazon recently. There's a chocolate that's been sold out of the Autonola estate in St. Joseph to Harrods. Harrods is this it's like this high-end mall on Oxford Street in England, and they only sell like really luxury type items, and there's a chocolate that's manufactured out of Trinidad from an Autonola in St. Joseph that sells there. So the earnings that they make across there, which would be in pounds, right, is repatriated back here, and that's the earnings from abroad that I'm talking about. Yeah. There's also net income from foreign assets, also called net property income from abroad. So this is calculated by subtracting payments to foreigners owning local assets from income received from assets held abroad by citizens, right? So this figure could be positive or negative. There's a net national product or national income, right? And the definition for national income includes some adjustment for depreciation. So this takes the gross national product and subtract depreciation from it. And depreciation is the reduction in capital stock. Capital stock, you know, is the things that is owned by the country. So since the gross national product figures do not always accurately measure the standard of living, there are other indices that could be used. There's the per capita gross national product, and we find this by dividing the country's total gross national product by its total population. So if, for example, a country has a gross national product of $40 million and has a population of 5,000, then its per capita gross national product is going to be $8,000. We divide the 40 million by 5,000. So what that means is that each citizen enjoys on average $8,000 worth of goods and services, right, over a period of, let's say, a year. Now, the impact of national income on the standard of living and the quality of life. So an increase in the national income usually relates or translates from an increase in the output of goods produced, increase in incomes, or increased expenditure, right? These are all indicators of positive growth inside of an economy. And because of this, given an increase, because these are all increases, if they increase, it also leads to an increase in the standard of living. But if the incomes are not evenly distributed, the standard of living of the population could be uneven. And we do see that in some countries, some South American countries have that problem, right? Also, an increase in incomes for the population does not necessarily mean that the quality of their lives have improved, right? Because there may still be a significant amount of the population that don't have access to clean water, proper healthcare system, education, and these areas don't receive any kind of investment at all. Again, in a lot of developing countries, we would see situations like that. So an increase in your national income is usually due to increase in your output of goods produced, increase in incomes, or increase in expenditure. And how is that so? All of these factors are interconnected to a national income because one, an increase in output of goods produced, right, basically means that when the economy is producing more goods and services, this is going to boost or increase the overall national income, right? And this is so because the value of these additional goods and services is going to contribute, right, to the overall income that is being generated within the country, within the economy. Also, increased incomes. If there are higher incomes from individuals and businesses, this could also lead to an increase in national income. So when people earn more, they tend to have more to spend or even save or invest. And again, that contributes to the overall income of the nation increasing. Increased expenditure. When we talk about expenditure here, we're talking about the overall spending in the economy, whether it's by the consumers, businesses, or the government. And if any of these parties increase their spending, this is going to stimulate economic activity. If the consumers are buying more, it means that businesses are going to earn more revenue. If they earn more revenue, then they could spend money in other areas. They could expand their business. They could hire more people, right? So generally, when people or entities inside of the economy, such as businesses and the government, spend more, it encourages businesses to produce more. And this in turn causes an increase in income. Yeah, everybody all right with that? Make sense? So now we want to talk about calculating national income. This is something that you need to know briefly about, right? It's a kind of complex, but we're going to break it down into some 3 methods that is commonly used, and we'll try to explain them in a simple way. We're not going to go too deep into the formulas, but we'll give you a basic idea in terms of how they work. Yeah? So the first method that we're going to discuss is something called the income method. And the income method primarily focuses on the income earned by all your factors of production, your land, your labor, your capital, and entrepreneurship as well, right? It's like looking at how much money everyone makes in the country. So national income here, using this income method, looks at the compensation of employees. When we talk compensation of employees, we're talking about the salaries and the wages that is paid to workers, plus any type of rent, interest, and profit, right? And rent, interest, and profit, they are viewed as the same in this production method. The other method is called the expenditure method. And basically, this method, as the name implies, it adds up all of the spending in the economy. And this is regardless whether the spending is done by individuals, businesses, or government. So it's like counting all the money that gets spent on goods and services. So using this method, national income is calculated as follows. We look at consumption plus investment plus government spending plus the difference between our exports and imports, right? We call that the balance of trade. So consumption basically is what people spend on things like food, clothing, electronics, right? And other goods and services. When we talk about investment, we're talking about spending as made on things like machinery, right? For businesses to automate or make their processes more efficient, buildings for more space in order to produce, and new businesses. Government spending is the spending that government makes on public services. So, for example, on fixing roadways, right? Installing more electricity to parts of the country that may not have electricity, right? Additional water supply, spending in healthcare, right? That's a big one, right? Making certain services available through the health centers and things like medication and things like that. Exports, basically, well, we know these are goods and services that are sold to other countries, and imports are what the country buys from other countries. Yeah, this is our expenditure method. The next method that we're going to talk about, right? We cover all three: expenditure, income, and production. Yeah, we did all three, right? So basically, when we calculate the national income, what we have to remember is that each of these methods could give a different perspective on the size of the economy, and rather so the health of the economy. So you find that different countries tend to use one or maybe more of these methods depending on how their economic structure is, right? So when I say economic structure, are they the free market capitalist type, monopolistic type structure, right? Is it a command economy? Is it a mixed economy, right? As well as things like data availability. So these influence which type of method they would use. But all in all of them is trying to measure the economic activity in the country. They're just looking at it from different perspectives, from different angles. Yeah. Now we want to discuss economic growth and by extension, economic development as well, right? What influences growth in the economy? Economic growth, basically, you can think about it as like this process or this method through which we can increase the amount of money that is available in the country. It's like making the country's money pot bigger, right? So we check how much it grows from year to year. Sometimes, you may hear the finance minister giving a budget and he'd say that, we expect how much ever percent increase in the economy over the next year. And how this happens or what causes this to happen is when the country becomes better at making stuff or they become more efficient at it. So there's less wastage. So economic growth could come from things like finding those new stuff to use, right? Guyana is a good example of that. They've always have these large supplies of natural resources, but they're now able to tap into some of these resources, right? Because of the foreign direct investment in the country by companies like Exxon Mobil and these other type of oil companies, right? Other countries could experience economic growth if they're using stuff that they have in a much more efficient way, in a smarter way, right? Some countries develop over time because of that. China is a good example of that. Getting better at using technology. When you look at other countries like Taiwan, right, Korea, even China, so to speak, improvements in technology helps or stimulates economic growth. China has some of the fastest railway systems in the world. And because of that, they could move resources and people throughout their country, because it's a very large country, at a much faster rate. So you could move people from one part of the country to another part. So that means you could increase your labor supply, because now you could bring people into the more, from the rural areas into the urban areas at a much faster rate and a larger volume. And it goes without saying, making the work more efficient is going to help with economic growth because there's less wastage, right? There's less wastage. So you can employ the extra resources somewhere else. So basically, it's like a game of making more and better things every year. That's how our country is going to achieve economic growth. Now, there could be negative growth. Sometimes a country experiences negative growth. And this happens when the ability to produce things goes down from one period to another. A lot of countries saw that during the COVID period, right? During the pandemic. Because why? Some industries was just dormant for a while. It could also mean negative growth, that the economy isn't getting better and making more stuff, right? They could experience growth without development as well. Some countries could grow its economy without making life better for everybody. So it means that even though the economy is getting bigger and people is making more money, poverty and unemployment could still go up because the money is not being distributed equally. It's not being distributed evenly, and there's a high level of corruption and dishonesty. So you find that there's a high level of poverty, a high level of unemployment. But yet still, when you look at the figures, you are seeing that the economy is growing. And you see that a lot with a lot of developing nations. Yeah. So when we talk about economic development, because you talk about economic growth so far, that's like increasing the money pot of the country, making it better. More money had been made from one period to another. Economic development now is where we're talking about upgrading the quality of the economy. So it's about making life better, right? Improving people's skills and knowledge, giving them more freedom. Excuse me. So this happens when the economy keeps growing, but it also changes in an important way. So what I mean by that is a country might sell more to other countries and end up buying less from them. They rely less on foreign aid and they build better infrastructure like roads and buildings. That's economic development. These changes help the country to make more money, right? There's one African country that had experienced this economic growth. Could have been somewhere between the period of 1998 to 2000, somewhere around there, which was Libya, right? They began with economic growth because they're a country that's rich in natural resources. It's no longer that case. If you check up on Libya now, there was a change in regime, and what happened is that, you know, all of that wood just went down. But at their heyday, or in the times of great economic growth and development and expansion, a lot of attention was placed on one, relying less on foreign aid. At a certain point in time, they had no loans with the World Bank, right? They improved the infrastructure. There was this project that the current leader of that country did to bring fresh water into the country, because it's a very hot country if you look at where it's located and you read up about it. Their literacy rate was like around 98%. They provided free education for all their citizens. At that point in time, if a couple got married, they were given a home, right? They had free healthcare, and if the healthcare wasn't available in the country, they will then take them abroad, right? And make sure that they get the healthcare. That's what I'm talking about with economic development. That's an example of economic development. And that comes about as a result of economic growth. Again, I told you, they were involved in a lot of natural resources, oil, gas, coal, and a couple other minerals. So basically, what we do is we check how well this development is going by looking at things like a human development index, right? The infant mortality rate, how much babies survive on a yearly basis. Your literacy rate, how much people could read and write, right? That's your economic development. But why is it important, and how does that tie in with what we call human resource development, right? So human resource development is where you are developing one of your most important resources, which is the actual people that reside in the country. So it's like investing in education to give like a superpower boost to the country's economy. So you find, and that's why that country did that. And then, you know, we even did that here in Trinidad. This is why we had like GATE, right? Government assisted tertiary expenses, I believe is the correct acronym for that. So you find that when people get a better education and they become smarter and, more importantly, more skilled, it means that they are better doing their jobs. They could fill certain vacancies that they may not have been before. So that makes the country more than able to produce more. And if it could produce more, this is how they're going to grow the economy. So when we talk about education here, we're not just talking about your traditional education in school. We're talking about training as well, right? Teaching people skills, even facts, how they should think and how they should act, right? There's this program that we have locally called the on-the-job training program, where they take people out of school, out of tertiary education, and they take them in. And there's some soft skills that they will learn there, in terms of, like importance of being punctual, basic etiquette and just dress code and stuff for the office space, how to meet and greet, public speaking. All of these are skills that is going to help them to make better choices in life. So it empowers the people. And if you improve the people in terms of their ability to work, then you will improve the overall process. A good example of that is in Japan, right? Japan did that, and they implemented something called the Total Quality Management System, right? TQM. And that system basically empowers each person, regardless of what their job is, to value the entire process that is being done. So even if they may be just a minor cog in the wheel, or they just involved in one part of the process, they understand that their role is very important, and they take greater pride in what they do. And even if they need to step above and beyond, they will do that so that the overall process, right, is done more efficiently. And if it's done more efficiently, you have a better quality product. Better quality products automatically attracts, more persons interested in that product. And you find that when countries invest in things like this, their human development, providing job training, coaching, mentoring, online learning, it's like planting seeds for the future, right? Because later on, they're going to reap the benefits of that. It's going to help reduce things like poverty, because now people are more educated. They could find better jobs, or more importantly, they could create new businesses, new ventures, because they now have, new talents, new skills. And in the long term, they tend to make more money. And that money is going to filter into the entire economy and generally lift the economy, cause growth and development. Yeah? Everybody with me so far? You all okay with this? You all understand that? Any questions?
No, sir.
No? Dan, any questions?
No, sir.
All right, so before we get into the next part of it, which is international trade, let's just recap what we talked about so far. So far we talked about standard of living, right? Anybody can remember what standard of living is? What are we checking? The country is something. It begins with W. Tangible. You're looking at what? The something of a country. Wealth. You remember now? The wealth of the country. Factors that influence the wealth of the country. And we said this is things that the quantity of goods that is produced and services that is consumed. Quantity of goods and services that is consumed in the country, right? We also talked about the quality of life. And we said the quality of life is something that's intangible in nature. So it's how well the citizens benefit from, right, or enjoy this wealth. Do they have good access to healthcare? Do they have high literacy rate? How do they feel as an individual rather as a population? Yeah. After talking about standard of living and quality of life, we went on to talk about national income and certain terms that we will use in national income. Some of them will include things like the gross domestic product, right? This looks at the total income from goods and services produced locally within the country. And then we expanded into the gross national product, which looks at the total income from goods and services produced both locally as domestic, as well as abroad, right? Foreign. We then talked about the circular flow of income. You remember that? How money moves from the consumers or the households into the businesses. The businesses are the ones that would usually purchase the factors of production from the households. And then in turn, that money goes back to the households through things like wages, right? And the households will spend by buying the goods from the firms and businesses. And we have that nice circular flow of income. We looked at national income and how we calculate it. We saw that there was 3 methods: the income method, the expenditure method, and the product method, right? Now we're going to dive into something called international trade, right? This is the trade that happens between countries. Here we're talking about imports and exports and why countries are going to engage in importing and exporting stuff, right? Why? Why would we do that? Why do you think we import things and we export other things? Can you give me an idea? Why do you think countries need to export and import? What's one obvious reason for that? Any clue? So what are some things that we import? Do we import apples? Yes? No? You use your mics. Make it a bit more interactive. Do we import apples into Trinidad? Dana?
So yes.
Yeah, we do. Why do we import apples?
Because it can't go here.
Exactly, because it can't grow there. And that's what international trade is about. Some countries are better adapted, or they're better suited for producing certain items, while others aren't, right? We probably export, or some Caribbean countries export bananas. At one point in time, we used to export sugarcane, cocoa, and coffee, right? The cocoa and coffee industry, they're kind of seeing a bit of rehabilitation happening, and there's government incentive, right? So the government is trying to incentivize that industry to kind of revive it, the export of coffee and cocoa locally. So what it is, and imagine trading baseball cards. Well, we don't really use baseball cards here locally, but I do remember when I was a kid in primary school, Sunshine Cornflakes used to have these cricket cards, right? And we had the different cricketers there, and there were some that were very unique in that they weren't much like it, right? But think about this, or that same example, on a larger scale. Some countries is going to swap goods and services with each other. And that's what we refer to international trade, right? And why do they do this? Because they have different things to offer. We can't grow apples, right? But we could offer bananas, or we could offer provisions, right? Or we could offer pineapples, or we could offer mangoes. So some countries are better at making some things, or are naturally adapted or suited for producing certain things, while others are not, right? So some countries are good at making cars. The Germans are excellent at making cars. But there are some Caribbean countries that are experts at growing bananas, right? We actually had an entire division or department in UWI that was dedicated to cocoa and coffee production, like research, full-blown research and that, right? So generally, by trading, countries could get stuff that they're not so good at making or not so good at producing, like apples in our example, and we could trade things that we are good at, like the coffee or the cocoa or sugar in years gone by. So there's some key elements and concepts that we need to understand with international trade. And there's some basic ones like imports. Imports are the goods and services that we will purchase from other countries. So we could purchase raw materials, consumer goods like what we have in the groceries and in our malls, right? The clothing material and things like that. Machinery. Sometimes when I pass in on the highway, I see Lifestyle Motors, and they have this brand, I think it's JCB, for tractors and heavy equipment. So countries import products that they are not readily available to do, or they're too expensive to produce domestically, right? We could grow apples. You could grow apples in a controlled environment. If we use containers and we set up a controlled environment with light and, we control the humidity and the temperature, we might be able to grow apples in a controlled environment, like in a big warehouse, probably not a container, right? But that's going to be at a huge cost. So it's cheaper to probably import the apples than to try to grow them here. Exports, on the other hand, are goods and services that is produced in the country and then sold to other nations. Grenada is known as the Spice Isle. I don't know if you know that, Grenada, which is one of our neighboring countries, because they produce a lot of spice, nutmeg, cinnamon. Do they do cinnamon? I'm not sure about the cinnamon, but I do know they do nutmeg and you know, things like Mobi and stuff. Usually, right in our local market, Port-of-Spain market, I remember boats coming in, and the Grenadian people would always bring spices, and people in the market, they will go and purchase the things from the boats and then bring it and sell it in the market. Right? So exported products can range from manufactured goods like the noodles that we buy in the grocery to everything that I see in PriceSmart, to agricultural products, right? We're even importing sweet potatoes and avocados now, right? Services as well and intellectual property, right? You can export those services. Balance of trade. This is a term that is used to describe, I used it earlier on, the difference between the exports and imports. Generally, countries want to have a positive balance of trade. A positive balance of trade indicates that the country is exporting more than it's importing. And that's good, because that means that it is going to generate more foreign currency, right? But when we have a negative balance of trade, it means that you are importing more items than you're exporting, and we refer to that as a deficit. That's not so good, because then you're going to use up all the foreign currency in your local market to purchase goods above. And it also puts strain on the economy because you're not exporting as much as you're importing. There's also this term called a comparative advantage, right? It was a economic theory that was first developed by somebody called David Ricardo. And what it suggested was that countries should specialize in producing goods and services in which they have a comparative advantage, meaning that they could produce those goods more efficiently than other nations. So Grenada is more efficient at producing nutmeg for export than Trinidad is, right? And because of this comparative advantage they have, this allows and facilitates trading with other countries. So both countries benefit. We are better at producing natural gas. So if they require natural gas for their manufacturers, we could produce that and supply them with these things. We could trade those two items. Understand? There's this other concept called absolute advantage as well, another economic concept. And this refers to a situation where one country or a firm or even an individual could produce a particular good or service more efficiently and with a lower opportunity cost than another country, right? The opportunity cost looks at what you're giving up in order to produce this. So in other words, when one entity could produce more of a product using fewer of its resources in less time than another, that is what we refer to as the absolute advantage. And we're going to delve a bit more into that, right? Because this is something that tends to confuse students at times. So imagine for me that we have two countries, United States and China, and they both produce two goods. Both of them are producing smartphones. Both of them are producing clothing. But the United States can produce 50 smartphones in a day or 100 pieces of clothing. China, on the other hand, could produce 100 smartphones in a day or 50 pieces of clothing. So in this scenario that I've just described to you, the United States has an absolute advantage in producing clothing over China because it can produce more pieces of clothing, which is 100, compared to China, which can only produce 50. China, on the other hand, has an absolute advantage in producing smartphones because they could make more smartphones in a day compared to the US. They could do 100, the US does 50. That's basically what the absolute advantage in. So each country here in my scenario has an absolute advantage in a different product. The States is better at producing clothing, whereas China is better at producing smartphones. So this shows how an absolute advantage could lead to specialization and trade that would benefit both countries. It would make sense for the United States to specialize in the production of clothing, as well as it would make sense for China to specialize in the production of producing smartphones. Comparative advantage. So this was, as I mentioned before, where countries should specialize in producing goods and services in which they have a comparative advantage, meaning that they could produce these more efficiently than other nations. And it's a bit different from absolute advantage. So let's look at comparative advantage. So let's say the United States and Mexico now, they both have the ability to produce two goods, cars and electronics. The United States is highly efficient in producing cars, and this is because of their advanced technology and skilled labor. So they could produce 10,000 cars in a month, but they are a little less efficient in producing electronics, right? They only managed to produce 5,000 computers in a month. Mexico, on the other hand, has a workforce that is skilled in electronic manufacturing. It produces 5,000 cars in a month, but it excels in electronics production. They could produce 10,000 computers in a month. So let's look at that. So when we talk about comparative advantage, there's an evident comparative advantage between these two countries. The United States could produce one car with 1/10,000th of its resources, meaning one in a month, right? Because it could do 10,000 cars in a month. Whereas for the computer, it uses 1/5000th of its resources in a month. Compared with Mexico, Mexico could produce one car with 1/5000th of its resources in a month, and a computer with 1/10,000th of its resources. So what that means is that for the United States, it makes more sense to specialize in car production because 1/10,000th is much smaller than 1/5000th, right? That's like saying an 8 is smaller than a quarter, and that's true. An 8 is smaller. The larger that denominator, the smaller the fraction is. So the United States actually uses less of its resources to produce a car, right? Mexico, on the other hand, they should specialize in electronics because they use less of their resources to produce one computer. They use 1/10,000th of its resources in a month to produce the computer. So it means that the United States should produce 10,000 cars in a month, and Mexico should produce 10,000 computers in a month. Does that make sense to you? Right? Because of this comparative advantage, the two countries could exchange or engage in trade. The states would export cars to Mexico, and Mexico, and they would in turn export their computers to the states, right? So both countries end up with more goods than if they try to do everything on their own. And that's the main takeaway for comparative advantage. You don't want to try to do everything on your own. If you could find somebody else that does a better job at it, then the ones that you could do good on your own, you could say, well, listen, I have mangoes, but breadfruit doesn't grow good in my garden. So you want to exchange? I see you have a whole breadfruit field, right? But I have mangoes, so we could exchange, right? You're not going to try to produce everything on your own. So it's important because even though one country may not be the absolute best at producing everything, they should specialize in what they're better at and then trade with other countries. And what this does is it contributes to the countries in terms of their standard of living, right? Because production here again, it also leads to increasing efficiency because they're specializing in what they're good at. So let's compare the difference between comparative advantage and absolute advantage. So we have a short video. So just to summarize what we discussed and what we looked at, comparative advantage is really about giving up less to do something as the opportunity cost, and it leads to specialization and trade. Absolute advantage is about being the best or the fastest at doing something, regardless of what others could do. Some comparative advantage, it compares two countries or two businesses or entities and how they do this and how much it's going to cost them to do this or pursue a particular outcome, right? In comparison to the other. Both concepts, though, play a very crucial role in how countries and even people decide what to produce and what to trade and to make the most out of the resources and skills that they have available to themselves. So in our next session, we're going to look at reasons for international trade. We're going to be talking about economic integration, some economic institutions and systems, economic and social problems in the Caribbean and solutions to these economic and social problems that we find exist in the Caribbean. All right. Any questions before we wrap up? This is our question session or question segment now.